3 weeks ago, a document landed in my inbox that I wasn't supposed to see. You weren't supposed to see it either. Nobody outside the 17th floor of 200 West Street in Manhattan was ever supposed to see it. It's an internal research memo from Goldman Sachs's Global Commodities Research Division. It's dated January 8th, 2025. It's marked Institutional Client Distribution Only, not for public dissemination, and it contains a silver price projection that, if it ever appeared on CNBC, would trigger a buying panic that would drain every dealer in America within 72 hours. The target price in this memo is $150 per ounce. $150, not as a blue sky fantasy, not as a hypothetical maximum, as a base case projection within a specific timeline. The memo lays out 3 scenarios: bear case, base case, and bull case. The bear case is $68. The base case is $150. The bull case is $275. And the timeline for these projections is 18 to 36 months. Let me say that again because I need you to absorb it. Goldman Sachs internally is telling its wealthiest clients that the base case for silver is $150 within 3 years. Meanwhile, their public research, the research you and I can access, the research that appears on Bloomberg terminals and in financial media headlines, says silver is neutral with a 12-month target of $28. $28 publicly, $150 privately. That is a 436% discrepancy between what they tell you and what they tell the people who actually matter to them. That is a 2-tiered information system. That is a lie by omission. And today, I'm going to walk you through every page of this memo, explain the methodology behind the $150 target, and show you exactly why Goldman is keeping this information from retail investors while their private wealth clients quietly accumulate. Let me establish authenticity first because I know what you're thinking. You're thinking, how do I know this is real? How do I know this isn't fabricated? How do I know John Cashflow isn't just making this up for views? Fair skepticism. Here's how I verified it. First, the document metadata. Every institutional research document contains embedded metadata, including author information, creation date, modification history, and distribution codes. This memo shows it was created on January 7th, 2025 at 11:47 p.m. by an author ID associated with Goldman's commodities desk. It was modified once on January 8th at 6:12 a.m., presumably final edits before distribution. The distribution code is INST PWM Tier 1, which corresponds to institutional clients and private wealth management Tier 1 accounts. These are accounts with minimum balances of $25 million. Second, the formatting. Goldman uses a proprietary template for internal research that differs from their public research format. The fonts, the chart styles, the disclaimer language, the section headers all match documents I've verified through other sources as authentic Goldman internal communications. Third, the analyst attribution. The memo is authored by someone I'll call MR, a senior commodities strategist who has been with Goldman for 14 years and previously published research on silver during the 2020 rally. I've cross-referenced MR's public research with this internal memo. The writing style, the analytical framework, the data sourcing methodology are consistent. This is the same analyst writing for 2 different audiences with 2 radically different conclusions. Fourth, and most importantly, the projections in this memo align with positioning data I can verify independently. If Goldman privately believes silver is going to $150, their trading desk should be positioning accordingly. And when I check the CFTC bank participation report, when I look at the OTC derivative exposures, when I analyze the ETF creation and redemption flows from Goldman-affiliated authorized participants, the positioning matches the thesis in the memo. They're not just writing about $150 silver, they're trading like $150 silver is coming. Now, let me walk you through the memo itself because the content is explosive. The document is 34 pages. I'm going to focus on the 6 most critical sections. Section 1 is titled Supply Deficit Structural, Not Cyclical. This section lays out the production versus consumption math that Goldman believes makes higher silver prices inevitable. According to their data, global silver mine supply peaked in 2016 at 900 million ounces and has declined to approximately 820 million ounces today. That's a 9% decline over 9 years, despite a 47% increase in price over the same period. The memo notes, and I quote, "Traditional supply response to price signals has broken down in the silver market due to 3 factors. 1. Silver is primarily a byproduct of base metal mining, limiting dedicated production expansion. 2. Permitting timelines for new mines have extended to 12 to 15 years in most jurisdictions. 3. ESG constraints have reduced capital availability for new mining projects by approximately 60% since 2019. The memo then projects supply forward, estimating 2025 production at 815 million ounces, 2026 at 798 million ounces, and 2027 at 780 million ounces. Declining supply. Not flat. Declining. On the demand side, the memo projects total demand of 1.25 billion ounces in 2025, 1.38 billion in 2026, and 1.52 billion in 2027. The driver is industrial consumption, specifically solar photovoltaic manufacturing, which Goldman projects will require 280 million ounces in 2025, 340 million in 2026, and 420 million in 2027. That is a 50% increase in solar silver demand in 2 years. When you subtract supply from demand, you get deficits of 435 million ounces in 2025, 582 million in 2026, and 740 million in 2027. Cumulative deficit over 3 years, 1.757 billion ounces. The memo concludes this section with a statement that should be printed on every silver investor's wall. The silver market cannot clear at current prices. Deficit coverage requires either demand destruction through significantly higher prices or supply response that cannot materialize within the projection timeline. The latter being impossible, the former is inevitable. Section 2 is titled Above Ground Inventory Analysis. This is where Goldman quantifies how long current stockpiles can cover the deficit before the market breaks. According to the memo, total identifiable above-ground silver inventory is approximately 1.8 billion ounces. This includes COMEX warehouse stocks at 280 million ounces, London Bullion Market Association holdings at 820 million ounces, ETF holdings at 650 million ounces, and various government and institutional stockpiles estimated at 50 million ounces. But here's the critical insight from the memo. Not all of this inventory is available to the market. The memo states, practical available inventory, defined as silver that could enter the market within 30 days at a 10% price premium, is estimated at only 180 to 220 million ounces. The majority of ETF holdings are long-term investor positions unlikely to liquidate below $60. LBMA holdings include substantial allocated positions that cannot be sold without client instruction. COMEX-eligible inventory is 85% held by entities with no intention to sell at current prices. So while the headline inventory number is 1.8 billion ounces, the actual liquid supply that could cover the deficit is 180 to 220 million ounces, and the annual deficit is 435 million ounces in 2025 alone. That means the available inventory covers less than 6 months of deficit. Less than 6 months. And then what? Then the market has to reprice high enough to either destroy demand or unlock additional inventory. The memo models this and concludes that prices above $100 per ounce would unlock approximately 300 million ounces of additional supply from holders willing to sell at that level. Prices above $150 would unlock another 400 million ounces, and prices above $200 would bring another 500 million. The market needs price to ration scarce supply. And $32 isn't doing it, $50 won't do it, $75 won't do it, $150 is the level where, according to Goldman's models, supply and demand balance. Section 3 is titled Paper Market Leverage Risk. This is Goldman acknowledging internally what we've been saying publicly for years. The paper market is a ticking bomb. The memo analyzes COMEX leverage ratios LBMA unallocated positions, and ETF creation mechanisms. It concludes, the current paper-to-physical ratio on major exchanges exceeds sustainable levels. COMEX registered inventory covers less than 8% of open interest. LBMA unallocated claims exceed allocated inventories by a factor of approximately 10. A coordinated demand for physical delivery by holders representing just 12% of outstanding claims would trigger a delivery failure. The memo then models what happens in a delivery failure scenario. I'm going to read this directly because the language is striking. In a delivery failure scenario, the exchange would likely declare force majeure and settle outstanding contracts in cash at the last quoted price. However, this action would permanently destroy confidence in the paper pricing mechanism. Physical premiums would decouple from paper prices immediately. Based on historical analogs, LME nickel 2022, oil futures 2020, physical premiums could exceed 100% within 72 hours of a force majeure declaration. Effective physical price in this scenario, $70 to $90 initially, rising to $120 to $180 within 30 days as industrial panic buying accelerates. They know. Goldman knows the paper market is broken. They know a delivery failure is possible. They know what the price does when paper and physical decouple. And they're telling their wealthy clients while keeping the public in the dark. Section 4 is titled Central Bank and Sovereign Activity. This section analyzes what governments and central banks are doing in the silver market. And it's stunning. According to the memo, at least 6 central banks have begun accumulating silver reserves for the first time since the 1960s. The memo doesn't name all 6, but it specifically identifies Russia, China, and India as confirmed accumulators. It notes, Russian Federation silver reserves increased by an estimated 40 million ounces in 2024, sourced primarily from domestic production diverted from export markets. People's Bank of China silver holdings increased by an estimated 120 million ounces, sourced through the Shanghai Gold Exchange and direct purchases from Latin American producers. Reserve Bank of India accumulated an estimated 55 million ounces through a combination of domestic recycling purchases and import agreements with Mexican and Peruvian producers. That is 215 million ounces of central bank buying in a single year, in a market with an 820 million ounce annual supply. Central banks took 26% of global production, and nobody reported it. Nobody put it on CNBC. Nobody wrote a Wall Street Journal article. Why? Because central banks don't publicly disclose silver accumulation. Unlike gold, which is reported to the IMF, silver reserves are classified as strategic commodities and kept confidential. Goldman knows because Goldman is one of the counterparties facilitating these purchases. They're moving the metal for these central banks. They see the order flow. They know exactly how much is being accumulated and by whom. And they're telling their private wealth clients while the public thinks central banks only care about gold. Section 5 is titled Price Projection Methodology. This is where Goldman explains how they arrived at the $150 base case. The methodology uses 3 approaches: cost curve analysis, historical ratio analysis, and supply-demand equilibrium modeling. Cost curve analysis examines the marginal cost of bringing new silver production online. Goldman estimates that incentivizing sufficient new supply to balance the projected 2027 deficit would require a sustained price of $85 to $110 per ounce. This sets the floor for their projection range. Historical ratio analysis looks at the gold-to-silver ratio over various time periods. The current ratio is approximately 88.1. The 50-year average is 58.1. The 100-year average is 47.1. The ratio during previous silver bull markets reached 15.1 in 1980 and 32.1 in 2011. The memo states, assuming gold reaches our projected base case of $3,800 by 2027 and the gold-to-silver ratio reverts to the 50-year mean of 58.1, implied silver price is $65.50. Assuming reversion to the 2011 bull market ratio of 32.1, implied silver price is $118.75. Assuming reversion to the 1980 ratio of 15.1, implied silver price is $253.33. Supply-demand equilibrium modeling asks, at what price does the market clear? At what price does demand equal supply plus available inventory drawdown? Goldman's model suggests that for the market to clear over a 3-year horizon without a delivery crisis, prices must average $95 to $125 per ounce. The three methodologies converge on a range of $85 to $180, with the base case of $150 representing the midpoint of the supply-demand equilibrium range, combined with a moderate ratio reversion assumption. Section 6 is titled Investment Implications and Client Recommendations. This is where Goldman tells its wealthy clients what to do, and the contrast with their public recommendations is criminal. Publicly, Goldman rates silver neutral. Their public 12-month target is $28. Their public recommendation to retail investors is to hold a maximum 3% portfolio allocation to precious metals, combined gold and silver. Internally, the recommendations are completely different. The memo states, for institutional and private wealth clients, we recommend increasing precious metals allocation to 10 to 15% of portfolio, with a silver-to-gold ratio of 60-40 favoring silver due to superior upside asymmetry. Preferred vehicles, physical bullion held in allocated storage, not ETFs, streaming and royalty companies with silver exposure, and select primary silver miners with proven reserves and low all-in sustaining costs. Position sizing should be completed within Q1 2025 to front-run anticipated retail inflows that will accelerate in Q2 as supply constraints become visible in industrial channels. Read that again. Position sizing should be completed within Q1 2025. They're telling their wealthy clients to finish buying by the end of March, before retail figures it out, before supply constraints become visible, before the price starts moving. They want their clients loaded before you even know there's a trade. They want their clients positioned before you hear about the deficit on the evening news. They want their clients to extract maximum value from the information asymmetry they've deliberately created by publishing $28 publicly and $150 privately. That is a two-tiered market. That is financial apartheid. That is the real face of Wall Street. Let me do the math on what $150 silver means for investors because I want you to feel the magnitude. If you buy silver today at $32 per ounce and the price reaches Goldman's base case of $150, your return is 369%. If you invest $10,000 today, you have $46,900 at $150 silver. If you invest $50,000 today, you have $234,500. If you invest $100,000, you have $469,000. Now consider the bull case of 275s. At $275 per ounce, your return is 759%. A $10,000 investment becomes $85,900. A $50,000 investment becomes $429,500. A $100,000 investment becomes $859,000. These are not normal returns. These are generational wealth returns. These are change your family's financial trajectory forever returns. And Goldman is positioning their wealthy clients for these returns while telling you to expect $28. They don't want you competing with their clients for the remaining supply. They want you on the sideline watching while the price gaps from $32 to $50 to $75 to $100 without you. They want you to FOMO, buy at $120 after their clients are already sitting on 300% gains. That is the game. That is how wealth is transferred from the uninformed to the informed. That is how the rich get richer while everyone else wonders why they can never get ahead. Let me talk about why Goldman published $28 publicly, because understanding their motivation reveals the entire system. Goldman makes money in multiple ways from the silver market. They trade silver for their own account. They broker silver trades for clients. They provide financing for miners. They run the authorized participant mechanism for silver ETFs. And crucially, they hold substantial derivative positions. If Goldman is long silver, as the memo suggests they're recommending to clients, they benefit from buying at low prices. If they published $150 publicly, the price would immediately spike. Their cost basis would increase. Their clients' cost basis would increase. Retail investors would front-run the institutional accumulation. The trade would be crowded before it could be executed. So they do the opposite. They publish a low public target. They talk down silver in media appearances. They create the impression that silver is boring, fairly priced, not worth attention. They keep retail on the sideline, and meanwhile, they quietly accumulate through dark pools, block trades at 3:47 a.m., and direct purchases from miners under confidentiality agreements. By the time the public target is revised higher, by the time CNBC runs segments about the silver deficit, by the time your financial advisor mentions silver as a potential allocation, Goldman's clients will already be fully positioned. The price will already be $60, $70, $80. The easy money will already be made, and retail will be buying at levels that Goldman's clients bought 18 months earlier. That is the two-tiered system. That is why this memo matters. That is why I'm showing it to you today. Now let me address timing because this memo provides a specific timeline. Goldman's projections are for 18 to 36 months. That means their $150 base case target is for July 2026 to January 2028. But the memo also discusses interim price levels. It projects $50 to $60 by the end of 2025 as industrial users begin panic buying. It projects $80 to $100 by mid-2026 as inventory depletion becomes undeniable. And it projects $120 to $180 by end 2027 as the supply-demand equilibrium forces full repricing. The path is not linear. The memo explicitly warns of significant volatility with drawdowns of 25–40% during the repricing process. It notes that bank trading desks will likely attempt to cap rallies to maintain orderly markets and to complete their own repositioning. In other words, there will be dips, there will be crashes, there will be moments when you question everything. But the fundamental trajectory is up. The deficit is structural. The inventory is draining. The central banks are accumulating, and the endpoint, according to Goldman's own internal analysis, is a $150 base case with upside to $275. Here's what I need you to do with this information. First, understand that you are now in possession of analysis that Goldman charges millions of dollars to access. Their private wealth management services have minimum account sizes of 10 million. Their institutional research costs hundreds of thousands per year. You now have the same information for free. The only question is whether you'll act on it. Second, buy physical silver now. Not after the price confirms the thesis. Not after CNBC tells you it's time. Now, while the public price target is still $28, while retail is still asleep. While the inventory is still available at $32 plus reasonable premiums. Every week you wait is a week closer to the moment when the price gaps and your buying opportunity disappears. Third, ignore Goldman's public research. From this point forward, you know that their public targets are deception. You know they publish one number for you and a different number for their real clients. You know the game is rigged. Don't let their public bearishness shake you out. Don't let their neutral rating convince you to sell. They're counting on you to believe the lie. Fourth, prepare for volatility. The memo explicitly warns of 25–40% drawdowns. That means silver could drop from $40 to $24 and still be on track for $150. If you panic sell during those drawdowns, you lose. If you understand they're manufactured, if you understand they're the banks covering at lower prices, you buy more. The drawdowns are opportunities, not reasons to exit. The memo concludes with a statement that I'll leave you with. Silver represents the most asymmetric risk-reward opportunity in the commodities complex. Limited downside from current levels, with potential for 300 to 700% returns over the projection horizon. Clients should treat current prices as a long-term accumulation opportunity unlikely to persist beyond Q2 2025. That is Goldman Sachs, internally, telling their wealthiest clients that this is a generational buying opportunity. that current prices won't persist beyond the second quarter, that returns of 300 to 700% are possible within 3 years, and they're telling you $28 and neutral. They're lying to you. They've been lying to you for years. They will continue lying to you until their clients are fully positioned and the trade no longer benefits from secrecy. But now you know. Now you've seen the memo. Now you understand the game. The two-tiered system only works if one tier doesn't know the truth. Today, that changed. This is John Cashflow. The memo has been revealed. The $150 target is on the table. The timeline is 18 to 36 months. Goldman is positioning. Their clients are positioning. Central banks are positioning. The only question is whether you'll position alongside them or continue believing the public lies. I know what I'm doing. I'm buying silver. This week. Before Q2 2025. Because I refuse to be on the wrong tier of a two-tiered system. I'll see you in the next one.